Will everyone else have to log in again?
So the participants, I apologize everyone for the technical issue. I see some of the participants are logging back in.
Okay, let's
Resume.
keep our fingers crossed, everyone, that we continue through this one unabated. As I was in the process of telling about SCORE, our focus is on the small business community, and our mission is fostering successful business communities through mentoring and education. This webinar is a component or element of the education portion of our mission. Next slide. Hosting today's webinar are the chapters of the Hudson Valley. Throughout this presentation, you may have questions, and if they are beyond the content of today's webinar, I would urge you to reach out to one of the chapters, either through the website, the phone, the email, and arrange to speak with a mentor. We're available to answer questions, and even though the bans on meeting are being lifted, we're making full use of video and other types of non-contact communication. So the business as usual, despite the time that we're in. Next slide. A little housekeeping here. All participants registered into the webinar today are muted, just for continuity of the presentation. At the bottom of your screen is a scroll bar, or excuse me, a bar of icons. The chat or question and answer, the question and answer is the tool we will use today. If during the presentation you have a question, type it into the Q&A section, and we will get to the questions either through the webinar. If they aren't answered during the presentation, we will attempt to answer all the questions, time permitting, at the end of the webinar. Next one. Today's presentation will be conducted by Alan Zabusky. Alan is a SCORE mentor, also in the Rockland chapter. He's a CPA and MBA specializing in finance and accounting. And the other key I would point to is Alan is also an adjunct professor at Fairleigh Dickinson, and he teaches accounting. So the content is extremely familiar with that, with Alan. Alan, with that, I'd like to turn this over to you now. Thank you.
Thank you, Bob, for your fine introduction. By the way, is also the chapter chair of the Rockland County chair, so he's my boss. So I'll be on perfect behavior for the next hour or so. To get a sense of our audience today, I'd like to ask you to answer 2 polling questions, which will be coming up in a few seconds. So the first one is, for how long have you been a small business owner? And the second is, what accounting or bookkeeping education have you had? So we'll allow about 30 seconds for you to respond to both polling questions, and then we'll review the results together. Let's receive some results. So we have a more experienced, greatest percentage of our constituents here are 36% of individuals who've owned a small business for more than 6 years, declines to 22% in the first 2 years of business, and then 17% who are aspiring business owners. Good. In terms of what accounting education the group has had, I guess 31% of the group has had some high school or college accounting classes, 14% have a degree, and I guess 31% are getting by with trial and error, and 70% are just getting started. Okay, good. So our objectives for today's webinar, first, what is not an objective is to turn everyone here after an hour into an accountant or tax preparer. As my wife tells me, whenever she can't go to sleep, she asks me about my day, and that puts her out very, very quickly. But we're going to provide some transparency into the basic financial statements. We're going to convert some accounting speak into plain language. Accounting speak related to financial terms and concepts that all business owners really need to know, and help you intelligently discuss your accounting and reporting needs and process with your advisors, because it's important to have a basic knowledge of financial statements and how to use them. So the outline for today's webinar, first section will deal with your financial and operational information, how critical and why it's critical for a successful business. Second, we'll review some basic bookkeeping flows and the types of accounting systems and options available. Then we'll morph into an overview of the 3 basic financial statements, which include a deep dive into the income statement, the balance sheet, followed by the cash flow statement, and then go through a series of analytical techniques and tools in terms of how to leverage the financial information that's revealed in those financial statements to make them more meaningful, actionable, in order to manage your business successfully. And then we'll do a recap. So financial statements are akin to the report card of a business, and they're critical for owners and investors, whether those are your partners or third-party investors, lenders, whether they're banks or other organizations, and creditors, as well as regulators, to the extent that you're involved with regulators. We all have to deal with the IRS. That's certainly the ultimate regulator, but for various operations, depending upon the licenses they have to maintain in various state requirements, there may be some other regulatory agencies that require submission of financial information. And these financial statements contain a tremendous amount of information about a business. So we need to set them up properly, look at them regularly. The bookkeeping system, which we'll review in a few moments, keeps track of all the financial transactions, but there may be some additional operational information that you want to highlight and identify and report on an ongoing basis. Most important, these are the most significant tools for a business owner to measure success and performance. So starting with bookkeeping. Bookkeeping is the process by which we convert business transactions to identify the accounting information, the accounting impacts. The 4 basic streams of accounting transactions relate to sales transactions, whether we in the retail business or wholesale building selling a product, or we're service organizations, there are revenues that need to be tracked. Our purchases, whether they're in a manufacturing environment, the various raw materials, supplies and equipment, or a finished good in case of a real retail organization. Expenses that are paid, all utilities, including and payroll. And then finally, any financing transaction that the business owner finds himself into dealing with creditors. And the information from our bookkeeping of these transactions is what generates and creates the financial statements. You can use software. The most common small business package that's available and geared to a small business owner is something called QuickBooks. But Excel, if you're an experienced Excel user, certainly you can package that working with your accountant, but QuickBooks is a very easy to use, provide some structure and rigor that you don't have to start from scratch. In the old days, the old adage that a small business owner kept track of his business by keeping a cigar box. At the end of the day, if there was cash in the cigar box, he knew he had a good day. That morphed to a cash register, which became the first device that actually captured transactions and could capture receipts during the day. But today, given technological advances, the changes in consumer preferences, business owners really need to have a robust accounting system to be able to impart valuable information. So you need to set up that bookkeeping system carefully, crafted towards the type of organization that you're managing. I would always suggest the use of a professional advisor, whether it's an accountant, if you don't have that expertise and experience, to come in and assess what your business is and suggest what the type of bookkeeping environment and solutions that are most appropriate. But it also requires you to identify what information you believe you will need at the end of a period to be able to analyze and actually manage your business and to be able to manage the success of your operation. So there are two types of basic accounting systems, commonly called cash basis accounting, and the second, accrual accounting. Cash basis accounting is the most simplest term. It only accounts for events that impact cash, and no transactions recorded unless cash is actually involved. So no revenues or no sales are recorded until cash is actually received for the performance of the service or the sale, and no expenses recorded until a cash or check tendered. This is not typically used by most organizations. It is not what's considered a generally accepted accounting principle, but from a small business owner that's starting off initially, it may be appropriate. Contrast that with accrual-based accounting, where we record each transaction as it occurs. Sales are recorded when goods or services are actually delivered and provided, and expenses are recorded when they are incurred, irrespective of when cash is paid and when a liability is actually created. The advantages of the two systems, cash accounting, again, might be more appropriate for a startup with a few, if any, employees with no credit sales. In today's credit card environment and online environment, that's rare and not typical at all. The advantage, obviously, it's simple and easy. As opposed to accrual accounting, where there are no surprises at the end of a period, you've accounted for all the transactions that reflect economic reality. So all your sales have been recognized and all your expenses are recognized in the proper period, and requires the use of what's called double entry bookkeeping. So why should you learn about financials? Because again, it measures the results of your efforts and shows you where the money is, so to speak, where the money came from, where it went, and where it is currently. So let's take a 10,000-foot view of financial statements as an overview. We start with transactions, called it orders and activities. These are transactions, business transactions that occur during accounting period. The income statement reports those transactions and the financial impact during those periods. And the period could commonly be a month, a quarter, or a full year. Certainly for tax reporting purposes, required to report income on at least an annual basis. Public companies are required to report quarterly, and many companies report internally on a monthly basis as well. Then we move off to the balance sheet, which gives you a picture at a point in time of all the assets and liabilities at a given point in time. Commonly done at a point in time for which an accounting period ends. So producing an income statement for the first quarter of 2021, the balance sheet would be prepared as of March 31, 2021. And those transactions would then be characterized in terms of its impact on cash in the cash flow statement, which reflects the cash effects of all those events in terms of what happened in the income statement and any balance sheet changes. Again, only those that impact cash. So general concepts of the three basic financial statements. They're actually under generally accepted accounting principles. There are four financial statements, something called a statement of equity. For this purposes, we'll focus on the three basic financial statements, the income statement, the balance sheet, the cash flow statement. And they all are interdependent, so to speak. They each show a different aspect of the financial state of the company. If you produce two, you can easily produce the third. They appear to be complicated, but the basics, which we're going to review, are not very hard to understand. So we'll first look at the purpose and use of the P&L. P&L, commonly referred to as the income statement, reflects revenues and expenses over a period of time, and it allows you as the business owner and other users to evaluate the changes in sales and revenues compared to prior periods or compared to competitors and industry leaders. It reflects the changes in what's called, and we'll review these in more detail, the gross profit margin, operating profit margin, and net profit for those periods. Sorry. And again, you can compare your entity's profitability with other organizations to the extent that you have that information available. Now let's go into some detailed lines of the income statement. Again, the first major line is sales. These are revenues that result from the sales of a product or the providing of a service. It's typically referred as the top line of the income statement. We then have net sales. Some companies reduce that sales amount for certain directly related selling costs like commissions or outbound freight, but these could all be also shown in an expense section. And commonly, any discounts that you provide to the customers would also reduce the net sales. We then have cost of goods sold, which reflects the direct cost attributable to the product that was sold. In the case of an organization that purchases goods for resale, well, the cost of goods is actually the purchase price of the materials that resulted in the sale, and those be attributable specifically to those units. For a manufacturing company, it gets more complicated in terms as part of the manufacturing process. It's necessary to accumulate the cost of the raw materials procured into the manufacturing process and to cost directly attributable to the manufacturing process in terms of payroll, of applying direct labor in order to manufacture the product, and other directly attributable overhead costs that are directly attributable to the manufacturing process. All of this gets combined into the calculation of the cost of goods sold. The difference between net sales and cost of goods sold is referred to as gross profit or gross margin. And again, it's simply the sales less the cost of goods sold, which is a critical factor, which we'll see in a few minutes. From that gross margin or gross profit, that needs to fund various operating expenses. Again, these are expenses that are not directly attributable to the purchase of merchandise or the manufacturing costs associated with the manufacturing of that merchandise. And it includes payroll and other utility costs. These are commonly referred to as fixed costs, although obviously they can be somewhat semi-variable with volume. That reduces gross margin, and you come up with something called gross profit or operating income. Again, various terms that can be used for that. Then most financing transactions, or I should say many financing transactions, have financial terms and barometers and targets that the business owner need to meet in terms of thresholds. One of them is something called Ebitda, EBITDA, which is an acronym that simply means earnings before interest, taxes, depreciation, and amortization, because it reviews interest, taxes, and these other costs as sort of non-operating costs. So the creditor would like to see certain Ebitda targets achieved. And they may also as well require some net income targets, but this is another threshold that they might require. From there, we reduce for those non-operating costs, interest and depreciation, resulting down into net income or net profit, which is the net of all after all charges have been included. So let's look at an example of an income statement. This is a one-year income statement for a company to be named later. In the revenue section, we have sales of $55,000. We have commissions of $5,000, reducing the revenue down to net revenue of $50,000. And commonly for income statements, commonly expressed, we express certain lines of the income statement as percentage of revenues or sales to get a barometer as to what the gross margin and gross profit percentages versus the net income and net profit or net income percentages. So in this case, we then reduce net revenues for the cost of goods sold, which in this case includes raw materials, direct labor, and benefits. The total cost of goods sold of $30,000, which reduces net revenue coming down to a gross profit of $20,000, again, can be referred to as gross margin. So for this company, they've achieved a 40% gross margin percentage. So before paying any fixed expenses, they have a gross margin of 40% that's available to fund fixed expenses. I've counseled and mentored many small business clients who just weren't aware of the dynamics of their P&L. They couldn't tell me what their variable costs were versus their fixed costs. They couldn't tell me what their gross margin percentage was, and they couldn't tell me what their break-even point is, which we'll explain in a few minutes in terms of how many units would they have to sell in order to cover all their fixed expenses. Then we move down to the operating expenses, again, can be referred to as fixed expenses to the extent appropriate. We have labor, we have other utilities, and we have rent. Coming down to the profit from operations before non-operating expenses, in this case, $6,500, which represents 13% of sales. We reduce that further by non-operating expenses, in this case, interest expense and depreciation, which results in a net profit of $5,000. Again, the importance of these percentages are useful to compare to prior periods, compare to plan or expectations or forecasts, or compare these percentages against competitive information that you can get. Now, a note, you did notice that we didn't include taxes. Many of our small business owners, their legal structure are either as a sole proprietorship, where you, the owner, the taxpayer, and all the net income gets reflected typically on a Schedule C as part of your own personal income statement. In a partnership, the partners are as well the taxpayers, the partnership must produce what's called file a tax return, distribute Schedule Ks to each of the partners, and that Schedule K information and income is reported on the personal income tax return of the partners. S corps and LLCs are legal entities that are structured to provide, legal insulation from personal assets. They're both taxed like partnerships, and either recorded on a Schedule C for a single person LLC, or on Schedule Ks and reflected on the personal income tax return as well, because again, in these cases, the owners are the taxpayers. Unlike a C corporation, which is a full corporate entity, which has stockholders and is structured that the corporation actually files a tax return and pays taxes on its net income. Thus, you may have heard the term double taxation. That's because to the extent that the corporation distributes a dividend to the stockholders must report that dividend income on its tax return. And depending upon your tax situation and your income base, those dividends are also taxed. So that same net income is taxed first at the corporate level, and then secondly, taxed to some extent when it's distributed to stockholders. So now let's move into the specifics of the balance sheet, which is commonly referred to as a statement of financial position, and it reflects what a company owns, all its assets at a point in time, reflects what a company owes, its liabilities at a point in time, and its equity, the difference between assets and liabilities. Drilling down further, assets are impacted by how much it has to collect from customers, referred to as accounts receivable, how much cash it has. What a company owes reflects how much debt, whether it's short-term or long-term debt, whether it's financing short-term purchases or long-term debt in terms of expansion or purchase of equipment. And equity reflects the accumulation of how much equity has been invested over time, plus how much income has generated over time, less any distributions that have been made to the owners. Let's go into some detail line items of balance sheet. Again, it's a snapshot, reflects a snapshot of the assets and liabilities of the business at a singular point in time. Most commonly asset obviously is cash, which reflects all the bank balances. Second common item is accounts receivable, to the extent that you are offering services or sales for credit. It's what at any point in time your customers owe you. Inventory, again, to the extent that these are purchased goods that have not been sold yet, or can include various aspects of the manufacturing process, including raw materials and various supplies. We have property, plant, and equipment, long-term assets that are used in the business, net of any depreciation. Depreciation is an annual charge that's required to apportion the cost of the investment over its useful life. Intellectual property could be your patents, trademarks, and other soft assets that have been either purchased or in some cases actually developed internally. On the liability side, we have accounts payable. It's what you owe your suppliers, your vendors, or utility companies, to the extent that obviously your current month's utility bill will commonly be paid in the following month. So at the end of that current month, you have a liability to the utility company for those utilities. Debt, self-explanatory, whether it's short-term and long-term. And the short-term portion generally calculated as that amounts that are due within the 12 months of the balance sheet date, which consider the current portion, and any amounts that are due beyond 12 months of the balance sheet is referred to as a long portion of debt. Equity, in this case, shareholders' equity for a corporation, reflects the common stock, capital stock that had been originally issued, and retained earnings, the accumulation of the earnings over time. Again, the two components are capital stock, the original investment plus any additional investments that have been made over the course of time, plus retained earnings, which is the accumulation of the net profits that have not been paid out or net of any dividends that have been paid out. So simply balance sheet example. In this case, this company has total assets of $100,000, made up of a cash balance, various cash balances of $20,000, accounts receivable of $20,000, inventory of $30,000, and plant, property, and equipment of $30,000 net of any depreciation expense at that point in time. On the liability side, it has accounts payable. It has accrued payroll, again, because typically payroll is paid along a payroll cycle, whether it's week or bi-weekly, and generally doesn't coincide with the last day of a calendar month. So at any point in time at the end of a month, there may be some payroll that has not been paid out to the employees, and that represents a liability that the business has to its employees. In this case, bank debt for total liabilities of $28,000. It has original owners' investments, whether in terms of common stock or others, in terms of $50,000. The accumulated profits, in essence, the retained earnings that has been accumulated in the business, in essence, reinvested in the business and not distributed to the owners. So we have total equity of $72,000, coming down to total liabilities and equity of $100,000. One of the basic accounting principles is that total assets equals total liabilities and equity, or conversely, using algebra, you can solve equity is total assets minus liabilities. Now let's look into, in terms of creating your own balance sheet, some of the items that you have to identify in terms of whether it's germane and reflects really your business activity. In terms of cash, accumulating all the business bank accounts that you may have. Accounts receivable, again, depending on, are you extending credit or will everything be paid at the time of delivery of the product or service, which is rare these days. Will you have inventories, and what type of inventories? Will you have finished goods inventories in terms of the manufacturing process? Will you've completed the manufacturing process and resulted in a finished good, or you simply have purchased a completed product for resale or for wholesale? And will you have long-term assets in terms of properties, plant, or equipment? On the liability side, again, will you have liabilities to your creditors, to your suppliers, to your various vendors, and to utility companies? Will you have, again, accrued payroll if you have employees, again, because the payroll period generally will not coincide with the last day of a calendar month? And finally, will you have other liabilities? Will you have creditors? Will you have short-term lines of credits that you've pulled down from? Will you have credit card debt? Or will you have financing transactions with a bank or a third party? Important element is just like the income statement to compare against other periods. Same thing with the balance sheet. The common comparison point in time is from a previous period. So if this company were comparing balance sheets at the end of 2020 versus its comparable end of the prior year balance sheet. So we see assets have declined by $2,000 from period to period. Accounts receivable have increased as a result of greater sales volume, or it's a result of difficulty in collecting, or in your customers, given tumultuous time we find ourselves in paying off their liabilities or your receivables from them. Inventory is an increase in inventory. Again, does that reflect increased sales activity or increased manufacturing activity, or slowness in sales where you're accumulating inventory? And is that a deliberate decision or not? And plant, property, and equipment, in this case, growing from 28,000 to 30,000, which must reflect additional purchases of long-term investments. So our total assets in this case grew from 95,000 to 100,000. On liability side, again, accounts payable has increased. Again, is that typical, reflecting the increase in purchasing activity and other vendor activity? Accrued payroll in this case is the same at the end of each period. And bank debt has declined by $1,000 from 21,000 to 20,000, reflecting obviously must have paid off some principal balance of the bank debt. In the shareholders' equity section, we have the owner's investments, which are stable at 50,000, which obviously reflects no additional investments made by the owners in the last 12 months. And we have accumulated profits or retained earnings growing from 17 to 22,000, again, reflecting the profits of the company for the last 12 months, coming down to equity and coming down to, again, total assets, equal liabilities of equity of $100,000. So the
Alan,
yeah.
let me interrupt. I have a question in this area right now. Can you explain what makes up retained earnings and where they come from?
Okay, again, retained earnings reflects the accumulation of the net income minus net losses of the business since it began operations. So let's say this company began at the end of 2019, even though there is a balance sheet in 2019. Let's say it's a one-year operation. And for the full year 2000, it earned $5,000 in net income. So the accumulated profits would be $5,000. If we fast forward to a year from now, and at the end of 2021, it earned another $10,000 in the year 2021. Then the balance sheet at the end of December 2021 would reflect retained earnings of $15,000, reflecting the $5,000 of earnings in the first year operation and the $10,000 in the second year operation, assuming no dividends or distributions had been made from that accumulated earnings to the owners. So again, retained earnings reflects the accumulation of net income and net loss from the first day of operations, net of any distribution of those profits, because you can only distribute, in most states, you can only make a distribution, a dividend distribution out of positive retained earnings. less any distributions that have made in those times. So any additional investment, any purchases of additional common stock by a stockholder would not go into the retained earnings line or account. That would go into owner's investment, stockholders' equity. So the accumulated profits or retained earnings only reflects the accumulation of earnings losses in the business, less any distributions. Okay, now what's critical is to distinguish for purposes of balance sheet reporting and as well as financial analysis, working capital. And in order to do this, you must distinguish between current and long-term assets. Said before in terms of current and long-term liabilities. Similarly, current assets are assets you expect to convert into cash within the next 12 months of the balance sheet date, like obviously bank balances, accounts receivable, and inventory. Current liabilities, as conversely, are also liabilities expected to be funded and paid within 12 months of the balance sheet date, and typically includes things like accounts payable, the short-term portion of debt, and the current portion of long-term debt. And working capital is defined as current assets minus current liabilities, which is key to being able to run your business. It's key that that stays positive. It's a metric by which to assess that you can meet your obligations to your suppliers and vendors. Now we morph to the third financial statement, the cash flow statement. Its purpose is to provide liquidity and solvency information. It allows you to make projections of future cash flows and indicates the priorities of management, and also people like the term quality of earnings in terms of morphing sales and revenues into real cash. The cash flow statement very simply shows the inflows and outflows of cash for an accounting period. And all the items in the cash flow statement relate and come back directly to the income statement and the balance sheet. There are three distinct types of cash flows that are reflected in a cash flow statement. Cash flow from operations, and we'll review that in a moment. Cash flows from investment activities versus cash flows from financing activities. So there are three separate distinct sections of the cash flow statement to reflect these three distinct cash flows. And the bottom line of cash flow statement, this is not rocket science. It's simply the net cash and your cash balances that are reflected on your balance sheet for 2 points in time. This statement tries to reconcile or roll forward, in effect, the movements and changes of all the cash balances from one point in time to a second point in time. But again, cash is king in here because business can be very profitable on an income statement reflecting their revenues and sales on account. But if cash flows are not monitored correctly and appropriately, it can put you out of business. So the detailed elements of the cash flow statement referred to the first section is the cash flow from operating activities, which reflects the cash impacts of the income statement adjusted for a certain depreciation, and reflects the operating activities of the business, basically sales and the operating activities of the business, versus cash flows from investing activities reflects the purchases of long-term assets and the sales of long-term assets. So distinguishes these as investing activities versus the ongoing operating activities in the business. Versus the third section referred to as a cash flow from finance activities, which tries to capture the cash impacts from additional borrowings, from additional investments made into the business by its owners, and any financing that has been secured with creditors and other third parties. What's critical is now to take these financial statements and do effective review and analysis. Again, by looking at the balance sheet, it reflects a snapshot of the company at a point in time, how much it owns, how much it owes, and its equity, how much debt or leverage it has. We'll explain that in a few minutes as well. And how much needs still be collected from the customers based upon revenues, and how profitable has it been in terms of looking at that retained earnings section, which is the accumulation of profitability. Some tools to analyze the balance sheet include various ratios. And they're separated into liquidity ratios and solvency and leverage ratios, and we'll go through them in a few minutes. In terms of accounts receivable, there are common ratios that are referred to, calculated in terms of looking at turnover, how quickly your receivable balances turn over in a particular period, what your average collection period, how long it takes for you to convert your accounts receivable into cash. And then looking at inventory, again, how quickly you can turn that inventory over in terms of sales, the number of days that you're maintaining, average number of days in your inventory balances, number of days that you're accumulating of sales in your inventory balances. So in terms of financial ratios, the common financial ratios, and again, I'm going to review this very, very quickly. After the session is over, you will all get an email with links to the record part of the session, as well as copies of the slides. So I urge you to review the slides in more detail with your financial advisor as appropriate. So the working capital mentioned before is simply current assets minus current liabilities. There's a ratio that's calculated called the current ratio, which is the current assets divided by current liabilities. And using this ratio, again, you can compare to prior periods, compare to projections to the extent you prepared projections, or some industry segments or competitor information that you may have. Then there's a debt to equity ratio, which is a simple calculation of taking total liabilities divided by total equity. And again, it's a measure of leverage in terms of how much of risk do the owners have in the enterprise versus third-party creditors. And obviously, the third-party creditors like a lower debt to equity ratio because it means there's more skin in the game, so to speak, by the owners or the investors. In terms of accounts receivable, again, I mentioned very quickly, there's a ratio, it's termed the accounts receivable turnover, which is simply taking the total sales divided by accounts receivable. And that ratio simply reflects the number of times in the year that your receivables are turning over. It's a measure how quickly your collections are. Obviously, as that ratio increases, it can indicate a concern, again, whether or not you're extending bad credit, so to speak, or some of your customers are having more difficulties, but it's something to be followed up on. You take that turnover ratio, another way of expressing it is taking that turnover ratio, dividing into 365 days of the year, and you can calculate the number of days that you have in your receivable balances, number of days of sales that you have in your receivable balance. Again, comparing to prior periods, comparing to other benchmarks that you may have, so you can react to in a meaningful way. Similarly, inventory turnover calculated as cost of goods sold divided by inventory. Again, that ratio, an expression of how quickly you're turning over your inventory. The higher the number in this case is more favorable. The lower number would be unfavorable, especially as it decreases over time, which means you're keeping inventory longer, whether that's obsolete inventory that you can't move, or your sales activity is declining, or you're simply purchasing or manufacturing too much inventory at a point in time. You take that same turnover ratio, you divide that into 365 days, and you get a measure in terms of the number of days that it's taking you to sell the inventory. Likewise, on the income statement, as I mentioned, the gross profit margin is a critical percentage, which is simply the gross margin divided by sales, in this case resulting in a gross profit margin of 35.5%. Again, an indicator of what the margin is available to fund fixed expenses and other operating expenses. Selling, general, and administrative expenses, in this case calculated as selling, general, and administrative expenses divided by revenues, resulting in a 22.9% ratio. And then operating profit, again, all as a measure versus sales or revenues, In this case, an operating profit of 12.5%. Again, relative in terms of plans, forecasts, prior periods, or benchmarks. Or in terms of forecasting, if you're trying to evaluate a new particular product line or a new service, using these estimates or using the estimates in your forecast to see how it impacts your gross margin percentage, how it impacts your various other elements of your income statement. And then finally, net profit after tax, in this case, again, at 9.3% result. Other common ratios that are used by finance teams, return on assets, which reflects how efficient management is using its assets. So it's simply the net income divided by total assets. And again, only relevant when comparison to some sort of benchmark or standard. Return on equity, again, measures the efficiency of management with the equity, which the total equity that has been invested and accumulated over time. And basically that's the return that's sort of you're not guaranteeing, but you're offering to your stakeholders, to your investors, to the extent that they're keeping their money reinvested in the business. What kind of returns can they look at? Can they turn to and look towards in terms of maintaining their investments in the company? And then looking at specific investment options or opportunities, calculation referred to as ROI, return on investment, which looks at the efficiency of a particular investment, again, all based upon forecast and plans about the future performance of that particular investment and what type of earnings it might throw off. I mentioned very briefly break-even point, which is a critical metric that most business owners don't use, and basically represents the amount of sales that you have to generate or earn in order to pay your fixed costs, in essence, break even. And again, in my conversation with various small business owners, that's not a concept that they commonly look to. In many cases, they don't understand the difference between variable expenses and fixed expenses. And they have never done projections in terms of, various product lines, if you will, various product services in terms of which one generates more gross margin, which can fund operating expenses more readily than others. In this case, it requires the use of, again, definition of your contribution margin, which is on your given amount of sales or a particular sale, particular revenue, what your associated cost of goods sold is relating to that unit. So in this case, we've sold $50,000 worth of products at 5,000 units at $10 each. The gross profit was $20,000, or we generated a $4 gross profit per unit. Let's say our fixed costs are $15,000. So our break-even point is simply calculated based upon taking the total fixed cost of $15,000 divided by the $4 gross profit per unit, resulting in 3,750 units. And that's the number of units that you must sell to generate revenues that will fund the fixed cost of $15,000. Obviously, every unit sold over 3,750 produces a profit after fixed costs. But this is a key metric that many business owners don't use and they don't really know. And it's certainly critical when evaluating against various opportunities, various options, looking at various products that you have available, where you may be surprised to know that certain products may not be generating the gross margin that's necessary. And if you focus more attention on a different product, that may result in more profitability to the organization. Again, the break-even point reflects you're not making money at that point, but any additional sale beyond that break-even point does generate net profit. So understanding financial statements is just the beginning. And in order, not only the investment made to be able to accumulate all the financial information and generate the financial statements, but it's only of value if it comes from actually using them effectively and learning to use them and read them to manage your business successfully is the critical point. As I mentioned throughout the statements, using the financial statement to compare to actual prior period results or plans or expectations is critical in order to identify opportunities for action. So are the deviations due to things you can't control? And so what are they? Are deviations due to simply internal management issues, whether it's accounting errors, bad planning, or so, or deviations due to poor sales environment, an inability to control and monitor expenses, and the effectiveness of your product, service, and delivery, and how can you institute actions to avoid this in the future. Or if simply the plan or the forecasts are just incorrect, they were based upon invalid assumptions, revise that plan and forecast as well, or use the actual emerging results to update and correct the plans and forecasts in order to make intelligent decisions. So to summarize, financial statements contain a tremendous amount of information about a business. We talked initially about bookkeeping, which is the flow of the accounting transactions which are critical to producing the financial records. We reviewed the income statement, which summarizes the results of a business for a particular period of time, whether it's a month, quarter, or year. The balance sheet is a snapshot at a singular point in time, which reflects the assets owned and the liabilities owed, and the accumulation of investment and earnings. Cash flow statement shows the inflows and outflows of cash for that accounting period, whether it's a month, quarter, or full year. And again, to use and leverage off of those financial statements effectively, you can use tools like comparisons, ratios, and other indicators that are useful management tools. So hopefully we have taken some of the mystery out of financial statements, and I'll ask Bob to summarize any questions that we've accumulated over the course of the session.
Well, thank you, Alan. First of all, this is an important subject for anyone in business, and I can tell by the number of people that are attending, they feel the same way. So again, thank you for a good presentation, Alan. Now, with regards to questions, there have been a few through the presentation. One I interrupted you on just to cover, and I have been filling them out as we've been going along. Right now, there doesn't seem to be any open item on it. So Alan, if I may, I think I'm going to bring this to a close. I want to thank everyone for attending. SCORE does this, as I said initially, as part of our mission to help the small business community. If you have further questions on accounting or business in general, you're more than welcome to seek us out. Look up the SCORE chapter closest to you on their website. Contact us. If you want to talk to a mentor, just reach out. We're here for the single purpose of helping you become successful in your business. So with that, I want to thank everyone again for attending. And it's a beautiful day in the Hudson Valley. Enjoy the rest of the day as best you can and have a great weekend. Thank you, everyone.